In this video, we'll introduce you and Peter to 8 dividend stocks capable of generating over $1,000 indefinitely with minimal risk, which are aligned with Warren Buffett's investment principles. This video will be divided into 2 parts. The first and arguably most crucial segment will discuss why companies distribute dividends, what investors can expect from them, and the potential pitfalls to avoid. It's essential not to skip this part, as we'll be sharing vital details that can help you get ahead of most dividend investors. And then, after covering that, we'll explore 8 exceptional dividend stocks that have the potential to significantly change your life and build your wealth, provided that you make the right decisions. So without further ado, the reason why companies pay dividends is because when they do make profits, they've got to figure out what to do with that money to improve productivity. And they've got a couple of good options like simply reinvesting it. For instance, a growing new company can decide to put that money back into their business to improve their products and expand their market share. But there is a second option. When it comes to turning over profits, companies also have the flexibility to distribute some of that profit to their shareholders through cash dividend payments. By simply owning a dividend-paying stock, you can typically receive a cash dividend payment every quarter, which is the standard schedule, or once every 6, 4, or even every month. But in any case, when you reinvest these dividends over time, the impact can be quite remarkable. Now, when searching for a dividend stock, many people fall into the trap of choosing companies with the highest dividend yields, often over 10%, and investing solely based on the expectation of short-term growth. This approach is a significant mistake for several reasons. Firstly, it focuses on quick gains rather than investing in the fundamentals of the company itself. Warren Buffett once said,
"Stocks are safe for the long run and they're very unsafe for tomorrow."
In the context of dividends, always going for the ones with the highest yield almost assuredly cripples an investor into something experts call a dividend trap. For the uninitiated, this is a situation where investors are lured into buying a stock solely based on its high dividend yield without considering other important factors, such as the company's financial health, the sustainability of the dividend, and future growth prospects. In a dividend trap, the company may be offering an unsustainably high dividend yield, usually in double figures, due to declining earnings, deteriorating financial conditions, or an inability to generate enough cash flow to support the dividend payments in the long term. And as a result, investors may end up suffering losses if the company is forced to cut or suspend its dividend, leading to a decline in the stock price. As a tip, you might want to consider only investing in higher yields lower than 7%, because it kinda tells you that the company is in a good position and its stock price hasn't fallen so much. Now, we're not saying all high-yield stocks are bad stocks, but rather, anytime you see a dividend yield above 7%, you might want to take a step back and do some more research. So on that note, here are 8 of the best dividend stocks aligned with Warren Buffett's investment strategies, which have a great potential to generate $1,000+ in dividends per month for you and Peter to consider buying. Starting with PepsiCo, a household name that we're all probably really familiar with. With a wide variety of products ranging from beverages to soft drinks, PepsiCo does swimmingly well in profit generation. And guess what? They also own Frito-Lay and Gatorade. Their dividend yield right now is 3.1%, which shows health and is pretty much in line with the companies that Warren Buffett wants us all to be involved with. You see, at the core of his investment strategies, he is betting on companies that offer long-term value rather than short-term trends or technologies that may become obsolete. Guided by his principle, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. PepsiCo is a staggering example. Consumers make purchases every day, and this makes Pepsi a well-oiled revenue-generating company. But speaking of Warren Buffett, you might be wondering why we're talking about Pepsi instead of Coke, which is actually another good dividend and ironically his preferred soda. Well, you see, it all boils down to the fact that Pepsi does a tad better in terms of diversification. Coke does exceptionally well in beverages, but Pepsi also sells great consumer packaged goods like chips, and it actually accounts for about 20% of their revenue. And that's a pretty good thing, because if you're looking for more growth, Pepsi will beat Coke in that area. Additionally, Pepsi is also a great company that's built a reputation. No matter how tough the economy is, Pepsi is going to probably be around for our entire lifetime because of their moat and the high demand for their products worldwide. Moving on, the second company on our list is Home Depot. But before we go into the goodies, do you remember when we told you that Warren Buffett always buys companies with long-term values? Believe it or not, this stock will make you and Peter hit the 4-figure threshold for an indefinite period. Apart from being one of the biggest companies in its industry in the US, Home Depot has a dividend yield of 2.38%. Again, it's not too high, but it's a good thing. Home Depot has been one of the most secure and stable companies in the entire world. And as a matter of fact, it is one of the only few companies that have outperformed the S&P 500 and NASDAQ over the last decade. Guys, Home Depot stands as the largest home improvement retailer in North America, boasting over 2,300 stores and $150 billion in revenues over the past 12 months. And when it comes down to revenue breakdown, almost half of the revenue comes from professional contractors, with the remaining half from DIY customers. And a big reason why this is crucial is that the revenue distribution is durable. If one segment reduces purchases, the other will help to offset the decline. And don't even get us started on the fact that the firm is pretty durable. They have 33% gross margins and 17% EBITDA margins, which means that their dividend won't be going anywhere anytime soon. So when you couple that with the fact that right now one can argue that the US is struggling in the home market as there aren't enough homes being built, Home Depot will surely benefit even more when the demand springs up to the max. Together with Lowe's, they've kind of monopolized the entire sector, and that's a pretty strong economic moat. You're not going to find anything better in its industry. Hey, remember when Warren Buffett said that the price is what you pay and value is what you get? Our third dividend stock addresses this pretty well. Not a lot of people consider AbbVie when it comes to dividend investing, but yeah, we think this needs to change. Headquartered in North Chicago, AbbVie is a biopharmaceutical company that owns a portfolio of drugs in different sectors like oncology, immunology, and neuroscience. And if you're still in doubt about why you need to pick this stock in your portfolio, just wait until you find out what it could do for Peter. To start with, this stock price has seen a price change of 16.52% so far this year, and it is currently paying a dividend of $1.55 per share. The medical firm has a dividend yield of 3.43%. In comparison, the large cap pharmaceutical industry's yield is 2.67%, while the S&P 500's yield is 1.56%. Ever heard of Humira? It's a drug that reduces pain and swelling caused by arthritis, as well as other skin disorders. It's one of the most successful drugs ever, regularly topping the best-selling drugs list annually. This amazing drug was developed by this company, so yeah, they do pretty well in terms of sales. Regarding dividend growth, AbbVie's current annualized dividend of $6.20 has risen by 4.7% compared to last year. And over the past 5 years, the firm has raised its dividend 5 times on a year-over-year basis, resulting in an average annual increase of 8.28%. The future growth of its dividends will be influenced by both earnings growth and the payout ratio, which represents the percentage of a company's annual earnings per share distributed as dividends. Currently, AbbVie's payout ratio stands at 53%, indicating that it allocated 53% of its trailing 12-month EPS as dividends. And given how the American healthcare system is a bit shaky at the moment, AbbVie is in a good position in their sector because they have leading patents on all kinds of drugs, and they continue to invest in R&D programs, the latter of which entails they'll keep diversifying their products and thus increasing their already strong economic moat. Speaking of which, if you've been paying attention so far, you must have heard us use the term moats often. And that's because the term is deeply grounded in the principles of Warren Buffett's value investing principles. Derived from water-filled trenches that surrounded castles to protect them from invaders, economic moats refer to a business's ability to maintain a competitive edge to protect its market share and profitability from rivals. Companies with these wide moats possess sustainable competitive advantages that act as barriers to both competition and economic downturns. enabling them to generate high returns on capital over an extended period. And yeah, in case you've been wondering, these advantages can come from all kinds of sources, including robust brand recognition, cost efficiency, network effects, regulatory licenses, and more. So now that you've gotten a nice understanding of what these moats entail for companies, let's go into JP Morgan Chase, the fourth company that you and Peter both need to acquire ASAP. Right now, they're paying a 2.24% dividend yield on their stock, which means that for every share that you own, you'll earn about $3 annually. That's not entirely a high yield per se, but it's worth noting that it was higher than the benchmark of the S&P 500 last year, which was around 1.7%. But hey, do you want to know what we love most about JP Morgan? It's the fact that they have a large amount of cash on their balance sheet. Back in the day, Warren Buffett bought candy from the C family for $25 million, much to his surprise. To the outside world, this acquisition was a bit boring. But alas, underneath the jeers lies a highly profitable business with extraordinarily attractive fundamentals and impeccable cash flow. And did this prove to be a success in the long run? Of course! But back to JP Morgan, they hold around $1.7 trillion in liquid assets, with over $700 billion of it in cash alone. And as a shareholder, it's going to give you a sense of security. It'll be really difficult to see JP Morgan at risk of bankruptcy. Remember the 2008 crisis? Despite the fears and collapse of many big financial institutions at the time, JP Morgan was still resolute, unlike companies like Lehman Brothers, for example. Plus, with the current trend of rising interest rates, JP Morgan is strongly positioned in the financial sector. As interest rates rise, banks stand to profit from the situation by leveraging the interest rate differential between what they charge customers and what they pay out. Consequently, we anticipate that net interest income for JP Morgan will continue to climb, particularly throughout this year and the next, as the Federal Reserve persists in combating inflation. If rates go higher, it'll stand to benefit JP Morgan. And even if rates don't go up, you can still rest assured that other benefits of investing in the firm will still make it a promising pick. Now, pick number 5 for you and Peter on our list today is Exxon Mobil, a controversial choice for a good reason. You see, stemming from its lack of alignment with green initiatives and the hope that the U.S. reliance on oil will diminish in the next few decades. For now, however, fossil fuel dependency is still pretty big. And despite the fact that EVs are becoming widely used and recognized, fossil fuel is still king right now. And guess what? Energy is still one of the sectors that has been outperforming since 2023. So it only makes sense for Peter to have his company from this industry in his portfolio. Warren Buffett's Berkshire Hathaway is renowned for its investments in stable, industry-leading companies. Among its top public equity holdings are oil and gas giants Chevron and Occidental Petroleum. Additionally, Berkshire holds a 92% stake in Berkshire Hathaway Energy, which surpasses the combined value of its Chevron and Occidental holdings. While Berkshire doesn't currently own Exxon Mobil, here's why we believe it stands out as the best choice in the energy sector. Remember when refined oil products like petroleum, gasoline, and more began to sell for a premium on the market? It's been a long time, but despite that, the prices are still not on the low side. Plus, with the current Ukraine-Russia war still going on and ending nowhere in sight, we don't really anticipate energy prices coming down anytime soon. Exxon right now is raking in the profits, and they pay their shareholders a 3.78% dividend yield, which amounts to around $3.52 per share per year that you own them. But why Exxon? You see, they recently acquired Pioneer Natural Resources in a deal slated to be finalized in Q2 of this year. Coupled with a substantial $26.325 billion in capital and exploration expenditures last year, this move sets the stage for an acceleration in global project development, with numerous milestones anticipated in 2025. And just like JP Morgan, they've got a lot of cash. In 2022, Exxon closed with $29.7 billion in cash. It generated $55.4 billion in cash flow from operations and had $4.1 billion from asset sales. After spending $23.4 billion on capital expenditures, it had a total free cash flow of $36.1 billion. Of this, $32.4 billion was distributed to shareholders through dividends and buybacks. But if you thought that that was impressive, they ended last year with $1.9 billion in additional cash on the balance sheet, showing it can still fund its operations while still supporting a rich share repurchase and dividend program with cash. And finally, they've got an amazing track record. Over the last decade, Exxon has demonstrated a strong dividend track record with solid yields. However, what truly enhances the appeal of their capital return program are the buybacks. In 2023, Exxon allocated $14.9 billion to dividends and $17.4 billion to stock buybacks, resulting in a 3.6% reduction in its outstanding share count while simultaneously decreasing its net debt position. Moving on, the sixth stock that you and Peter need to add to your portfolio is none other than Johnson & Johnson, a stock that Warren Buffett historically owned in large quantities and for good reason. Apart from the fact that they pay a dividend yield of 2.99%, which is even more than last year, Johnson & Johnson is another one of those stable companies that do well in any economic situation. No matter what, health is going to be a crucial part of our lives, and we need drugs to get better. If you weren't aware, Johnson & Johnson's flagship brands include Tylenol, Listerine, Band-Aid, Pepcid, Aveeno, and Zyrtec. And that's why the company remains resilient to economic downturns. Whether facing a recession, high inflation, or elevated interest rates, doctors continue to prescribe Johnson & Johnson products to their patients. But let's toss that aside for a bit. Another reason why we like Johnson & Johnson a lot is their dividend status. For over 50 years, J&J has consistently paid dividends to shareholders, with regular increases over time. It's a pure value stock that performs well in any possible metric, especially for the long term. Additionally, J&J also has a bunch of cash on their balance sheet, which again means 1, they have absolutely no risk of falling into bankruptcy anytime soon, and second, they're basically debt-free. 2024 isn't exactly projected to be a bad year in terms of economics, but even if we saw the worst recessions this year, J&J is one firm we think will survive. And that's why we, and the Oracle of Omaha as well, will continue to bank on Johnson & Johnson for a long time. Ladies and gents, there's a reason why Warren Buffett said this about Visa.
It's really quite a business, and we love the fact we own it.
But don't take his word for it. Visa runs the largest payment network in the world, handling over $14 trillion in transaction volume alone. And that's not even the best part. The firm takes advantage of its amazing competitive edge due to strong network effects that make amazing profit margins and impeccable cash flow. Personally, we think the trajectory for Visa globally can only get better, and that's why Peter can't afford to let this stock slip away from his portfolio, and that applies to you too. Since going public in 2008, Visa has consistently delivered market-beating returns, and the stock recently hit an all-time high. But amid inflationary pressures, sky-high interest rates, and high trades, here's why Visa remains an amazing pick for you. Like we said earlier, in 2022, the company handled a total transaction volume of $14.1 trillion, significantly surpassing its closest competitor, MasterCard, which processed $8.2 trillion. Smaller competitors such as American Express and Discover processed $1.5 trillion and $258 billion in volume respectively. And guess what? Visa earns fees whenever it processes payments for merchants, typically charging an average credit card processing fee from around 1% to 3%. But what makes Visa a truly compelling long-term investment opportunity is its wide margin for growth. Management says its network can support an additional $185 trillion in new volume with its account-based payments platform Visa Direct and its commercial cross-border platform Visa B2B Connect. The company has over 500 partners using Visa Direct, including some huge payment companies like Stripe, Fiserv, and Adyen. And as seen by Visa's profit margins, all of this offers it a strong network and competitive edge. The average margin over the last 10 years has been a remarkable 47%. Its slightly over $19 billion in free cash flow from the previous year gave them plenty of money to repurchase shares, pay dividends, and invest in new goods. We guess that's why Warren Buffett said this.
field where lots of people would love to take their customers away from them, but they have more customers than ever and they're spending more money than ever.
Now, last but certainly not least is Warren Buffett's ultimate company, which he described himself as a company better than anyone he owns. Already guessed it, of course, it is Apple. And yeah, just look at him wax lyrical about it.
Apple is different than the other businesses we own. It just happens to be a better business than any we own.
Alas, with a dividend yield of just around 0.56%, we know that some of you may be surprised that Apple made our list. But hey, make no mistake, it is the king of moats. Take a look at this.
Has a position with consumers, and if they had to give up a second car or give up their iPhone, they'd give up their second car.
You see, Apple has made exceptional returns over the past 15 years, and despite the fact that the latest release of the iPhone series didn't really gain a lot of fanfare, the company remains a true cash cow. In Apple's third quarter of 2023, iPhone sales came in at $39.7 billion. And just like Warren Buffett implied, Apple's brand name stands as one of the most valuable globally, driving continued purchases of its premium devices. This, coupled with its installed base of over 2 billion devices, underscores a deep and loyal ecosystem, offering numerous opportunities. Additionally, an area in which Apple is underrated is healthcare. The AirPods offer a hearing aid option, while the Apple Watch incorporates various health-related features like heart rate monitoring. Additionally, the company is exploring the possibility of transforming the Apple Watch into a continuous glucose monitoring device for individuals with diabetes. So as you can see, Apple's innovation is definitely going to take them places. They may have recently shelved their long-thought plans of going into the automobile industry, but their moat in tech is as large as ever and is not going away anytime soon. As a matter of fact, we think that it may even get better. But that's just subjective. The facts might point out that Apple doesn't have the most competitive dividend yield, at only 0.56% compared to the S&P 500's 1.54%. However, the company's payouts have more than doubled over the past decade, and its cash payout ratio stands at a conservative 14.8%. So in summary, Apple may not have the greatest yield, but it's a company that you and Peter need to heavily consider. For years, Warren Buffett's strategy has been a reliance on compounding, where he makes an investment and then sticks with it for years. Currently, there aren't a lot of firms better than Apple in this department, and that's why it's one of the ultimate stocks to buy and hold forever.